Welcome back. Hi. Okay, we're going to finish up with chapter 3 of chapter 5. Does that make sense? I don't know. Okay, so in objective number 6, in objective number 5, we used 0 in the formula. In objective number 6, we have a target profit, a profit that we want to make. So we can compute the number of units that must be sold to attain the target profit using either equation or formula, just like we were doing before with the break even. So profit equals unit contribution margin times quantity minus fixed expenses. Again, excuse me, our goal is to solve for the unknown Q, which represents the quantity of units that have to be sold to get the target profit. So suppose RBC's management wants to know how many bikes need to be sold to earn a target profit of 100,000. Well, we're going to go back to our formula again, actually our equation, but this time we're going to add that $100,000. That's our profit right there. And we still need to find out how many to sell. So Q is still our unknown. So we need to work the formula, work the equation down till we get an answer for Q. And Q is 900 units to get a $100,000 profit. Now with the formula, it's the same as before, except now instead of just fixed expenses divided by contribution margin per unit, it's target profit plus fixed expenses. So target profit is 100 grand, fixed expenses are still 80 grand, so that's 180 divided by the contribution margin per unit of 200. That gives us the same answer. Unit sales 900 to get that $100,000 profit. Now we can also go sales dollars like we were doing before, except for sales dollars, we're using the contribution margin ratio, not the contribution margin per unit. So the contribution margin ratio here is 40%. Our profit, $100,000, times the sales, minus the fixed expenses of 80 grand. Again, we're looking for that unknown of the number of sales, or dollar sales rather. So in this case, we work it down and sales are $450,000 to generate a profit of $100,000. And we can do the formula the same way. Target profit of 100 plus 80 is 180,000 divided by the contribution margin ratio, because we're looking for dollars here, comes to $450,000. Next, we're going to look at something called margin of safety. And really, the only thing about margin of safety is it's the difference between total sales and break even. And what it tells us is how much in sales can we lose before we start losing money. That's the break even, the difference between the two. Cost structure refers to the relative proportion of fixed and variable expenses in an organization. We've talked about that. Managers often have some latitude in determining the cost structure. Now, I typically suggested to the owners of the companies that I worked for that we keep the salaries low and give more bonuses based on profitability. In that way, we keep our fixed expenses lower and share the profits when we have them. But if things get tough, we still have a low enough fixed expense that we can meet it and we can pay the bills. Degree of operating leverage is an interesting number. Operating leverage is a measure of how sensitive net operating income is to percentage changes in sales. It's a measure at any given level of sales of how a percentage change in sales volume will affect profits. The way we do this is we take the contribution margin, right, sales minus variable cost, and divide it by the net operating income. So we're going back to RBC. This is RBC at 500 bikes with a $20,000 profit. we're going to take the contribution margin of $100,000 divided by the net income of 20, and we get an operating leverage of 5. So with an operating leverage of 5, if RBC increases its sales by 10%, net operating income would increase by 50%. Let's see if that works. 5 times 10, right? So in this case, we're increasing sales by 10%, right? 500 to 550. So sales are going from 250 to 275, 10% increase. But what's the increase in net operating income? 50%, from 20 to 30, because we have an operating leverage of 5. So increased sales are 25.20. Contribution margin goes to 28.48, and then we have a $1,548 net operating income, 44% increase. Companies generally compensate salespeople by paying either a commission based on sales or a salary plus commission. And that's, as I've explained before, I typically would push my good salespeople typically will push for a commission only, because typically if you get commission only, you get a higher percentage because you're not taking a salary. But let's take a look at this example. Pipeline Unlimited produces 2 types of surfboards, the XR7 and the Turbo. The XR7 sells for $100 and generates a contribution margin per unit of 25. The Turbo sells for $150 and earns a contribution margin per unit of 18. The sales force at Pipeline Unlimited is compensated based on sales commission. So remember, sales commission is a percentage of your dollar sales. So if you're on the sales force, you're going to push the Turbo. Why? Because the Turbo sells more, $150, so my commission is higher. But what's better for the company? The better for the company is the XR7 because it has a $25 contribution margin as opposed to 18 for the Turbo. To eliminate this type of conflict, commissions can be based on contribution margin rather than on selling price alone. I had this problem, a similar problem with another company I worked for many years ago, where the salespeople were paid their commissions based on sales. The problem was that the clients were slow payers. So if the client is paying slowly, but I have to pay you commission when you make the sale, I'm losing money. So what I did was I changed the commission basis. The commission basis was no longer on sales, it was on collections. And that incentivized the salespeople to make sure that their clients were paying fast. Sales mix is the relative proportion in which a company's products are sold. So when a company sells more than one product, they're always going to sell more of one than another, and that's the sales mix. What percentage of each one is being sold? So we're looking at the sales mix and break-even analysis for RBC here. We're seeing that RBC sells bicycles and they sell carts. The bicycles have a contribution margin of 40%. The carts, a contribution margin of 50%. And down here, it tells us the sales mix is 45% for bicycles and 55% for carts. So we see that when we work this through, the total contribution margin ratio is 48.2%. Dollar sales to break even. 170,000 is our fixed expenses. We had a 48.2% contribution margin ratio for the company. So the break-even sales are 352, 697. And that's the end of chapter 5. So as I always say at the end of the chapters, please don't hesitate to contact me. I've been having Zoom meetings with people. I actually had a couple of face-to-face meetings in my office. I am here for you. If you're feeling like you need to talk, like you want to make a plan for the rest of the semester, is there something in particular you want help with? I worked with somebody the other day just about how they approach taking an exam. Had nothing to do with what the content we were talking about. It was just taking an exam. So any kind of problems like that, please don't hesitate to contact me. I'm here for you. Have a great week.